The way we analyze and trade charts at Seneca is foundational in both classical charting and Elliott wave theory. Classical charting is all about identifying specific price patterns and using those price patterns to predict with a higher probability the direction of future price action. And Elliott wave theory is all about identifying different price waves, either impulsive or corrective, and then using the characteristics of those waves to identify future price action from that. So what we do is an amalgamation of these two things, where we also look for specific patterns that provide us with a higher probability of a certain outcome. And we also rely on Elliott wave theory in the understanding that price moves in waves, and these waves have certain characteristics. The very core of our analysis are three key principles of price action. The first one being price structure, the second one being the characteristics of corrective price action, and the third being the fractal nature of price waves. So this is, in essence, the foundation of our trading. And if you can understand these three principles, we can then predict price action with a high degree of certainty moving forward. So the number one is price structure. To understand price structure, we rely on Elliott wave's understanding that price moves in waves. What we understand is that price has impulsive waves and corrective waves. With our understanding of price structure, is that every impulse is followed by a correction, and every correction is followed by an impulse. And this provides us with a complete price structure. This impulse, correction, impulse is a complete structure for us. Following this, we will either get another correction, which sets us up for another impulse, making this the new structure, or what's to follow will be a change in structure, a new structure beginning, an impulse to the downside, a correction, and another impulse to the downside. And classical chartists would identify this as a head and shoulders pattern. So as you can see, with our understanding of price action, we go into a little bit more detail than understanding that this is just a head and shoulders pattern. So this understanding of price structure sets us up for a greater understanding of how the charts are going to perform moving forward. We can find a good example of this on the pound dollar US dollar chart. This is the weekly chart. And as you can see, we have this exact structure. We have our impulse to the downside. We have our corrective price action. And it's followed by an impulse to the downside. What we have at the moment, what we're getting in this instance, is more corrective price action, which gives us an understanding that what's to follow is further downside moving forward. And as you can see, this is what Elliott would describe as a 1, 2, 3, 4, 5 impulse wave to the downside. We don't actually count waves because we find that especially in the lower time frames, we often have more than 5 waves. So we rather just stick to the structure and the understanding that we have an impulse, then we'll have a correction, and that correction will be followed by an impulse. We then move on to the second of our key principles, which is the characteristics of corrective price action. So if we have our impulse and we have our correction, we understand that these corrections have certain characteristics which allow us to identify them. So we won't go into detail, but each of these corrections can be one of 3 categories, and those categories have 3 or 4 different types in each category. So we're looking at a total of around about 12 patterns, but 3 broad categories. Each of those categories provides very similar price characteristics. So what we will find is that every correction starts with initial corrective impulse. And that initial corrective impulse can either be simple or complex. By complex, we mean it'll just have further segmentation within it. We will then have choppy corrective price action, which is the core of the correction. And this choppy corrective price action can usually be broken down into its own impulse, correction, impulse structure. Once we see this choppy corrective price action, which then becomes identified as a B wave, we then understand that we can expect a C wave to follow, otherwise known as a secondary corrective impulse to the downside. As you'll see, most of these corrections follow the same characteristics. You'll have an initial corrective impulse, choppy corrective price action, and a secondary corrective impulse. All of this will be followed by a continuation impulse to the upside. It's the characteristics of this corrective price action that allows us to identify where in the price structure we sit and how we can trade moving forward. Going back to our chart where we see we have our impulse, correction, impulse, you will find the characteristics are consistent. So you'll see we'll have an initial corrective impulse, we'll have choppy corrective price action, and a secondary corrective impulse. Given our understanding of the characteristics of corrective price action, we can then begin to analyze charts and predict future price action with a high reliability. As we can see here, what we have is initial corrective impulse, choppy corrective price action, what we expect moving forward, and why we are bullish the pound dollar on the higher time frames, we can expect a secondary corrective impulse to the upside to complete the correction before price turns and heads lower. And because this is a higher time frame, we can then trade this impulse to the upside, this corrective impulse to the upside, and then switch that around and trade the impulse to the downside as the continuation occurs. Our third and arguably the most important principle is the fractal nature of price waves. So going back to our example, if this were a higher time frame price structure, what we would find is that each impulse would be made up of its own lower degree corrective patterns. Meaning, if you had to zoom into the lower time frames, you would find that this impulse would be made up of a series of price structures. You would see the impulse, correction, impulse structure play out in one of its many forms. In this case, it would be a 5-wave structure. We can actually just extend this up. But like we said, we don't count the waves because oftentimes we will find more than 5 waves within the structure. So we're not too concerned about the number of waves, but we do follow Elliott's theory that each wave is broken down into lower degree waves. So we have an impulse, a correction, an impulse. Impulse, correction, impulse. And that impulse becomes its own structure. We then are followed by a higher degree corrective pattern. And we'll see the same thing on the corrective impulses of this pattern. You will get the same structure on the corrective waves. You'll see an impulse, you'll see a correction, and that impulse, correction, impulse structure will maintain on the lower degree. We will then get our impulse to the upside. So what that means is that we not only trade the impulses, we can also trade the higher degree corrective impulses when they occur. So again, going back to our example, you will find that we have our impulse, correction, impulse price structure, but you will find that if we zoom in, you will find the fractal nature of waves. So going down into the daily time frame, and we see the same structure where we have an impulse to the downside. We have choppy corrective price action, which in this case is what we call a high momentum correction, followed by another impulse to the downside. Impulse, correction, impulse. And again, we'll find if we go into the lower degree time frames, we'll find the same structures. So if we're going to say the 8-hour chart, we zoom in on this area, we will find what we have is an impulse to the downside, our correction, and an impulse to the downside. Impulse, correction, impulse, which occurs on all time frames. It's the fractal nature of price action. And as we'll find, we zoom into this correction that we find on the 8-hour chart, and we will see the same thing. We have initial corrective impulse, choppy corrective price action, secondary corrective impulse, which completes our correction, and then we get our continuation impulse to the downside. So this occurs on all time frames and allows us to trade and predict charts to a high degree. So using this example, we'll show you how one of our biggest trades of the year, a pound-dollar short trade, banked us 20% in one trade. We then turned it around and started to profit on the upswing and remain in profit on the upswing. So as you can see, what we have is our price structure. We have our impulse, we have a correction, we have an impulse. And because of the nature of this price action, we understand that what we are sitting in is another correction rather than a change in price structure. So coming in closer to this correction, we will find that what we have is an initial corrective impulse, and we've had choppy corrective price action. And like I said, this choppy corrective price action can be further broken down. In this case, what we have is an initial impulse, what we call an expanding triangle, which is one of our patterns. Triangles being the category and expanding triangle being one of those 3 triangles. And then we have our secondary impulse, impulse, correction, impulse. In this case, it is of a corrective nature. Given this outlay, we knew that there was a trade to be made in this area because we had an impulse, we had a correction, and we were waiting for an impulse to the downside. Zooming into the lower time frames, and this is what we found. We had the completion of our pattern, which is the end of our E wave of our expanding triangle, and it was followed by an impulse to the downside, and we went into a correction. So as you can see, we have our initial corrective impulse, in this case a very long drawn out corrective price action, and a second corrective impulse. Now because we knew on the higher time frames was to follow was an impulse of this nature with a good indication that we were going to head down to these lows, we knew that this was a trade worth taking with a higher risk reward. So we got into our trade on the lower time frames in this area, and in this instance the trade moved in our favor very rapidly and almost went straight down, banking us our 20%, 22% to be exact. Following that, we knew, okay, once this middle section of the correction is complete, we need to see another impulse to the upside. So not only do we get out of the trade using a trailing stop loss, but we also entered the trade to the long side in this area to trade this impulse to the upside. And what we've had so far is an impulse. We now have choppy corrective price action. And what's to follow, we believe, is another impulse to the upside. So we remain bullish the pound dollar. And zooming out, you'll see how this lines up to our structure perfectly well. Once we trade this to the upside, we will again take profits on the upside and begin to trade this to the downside, because the higher structure suggests we are heading lower, more than likely towards parity on the pound dollar, heading into 2022, 2023. So it's this understanding of price structure, this understanding of the characteristics of corrective price action, and the understanding of the fractal nature of price waves that allows us to trade and analyze charts to a very high degree of accuracy. So all of this is just touching the surface of a much more detailed educational program that we get into in the Seneca Trading Academy. So what you'll find in the Seneca Trading Academy is our trading room, where we do our webinars, our analysis, and our trade breakdowns. And as you see, we get webinars twice a week, Mondays and Thursdays, in both London and New York time zones, as well as a monthly market preview where we run through our entire watch list to give you an understanding of what all the markets will be doing over the coming month. You'll also get access to our Slack group, where we post our trade ideas, our trade analysis, and where you can connect with other traders to help you on your journey. We have the 6-part education series where we run through these principles in far greater detail. You'll also find recordings of our webinars, which are posted shortly after the live webinars occur. So in our Monday market breakdowns, we run through the best trades for the week and tell you what's on our watch list and what we're looking at. And we then have a quick Q&A to run through any questions you may have for your charts, or any questions you have about the educational content. On Thursdays, we do an update of our Monday market watch list to show you exactly what's happening, what to expect moving forward. And then at the beginning of every month, we'll do a monthly market preview where we run through all the charts and give you a highlight of what to expect for the month. There's tons of value in our program, and we really look forward to helping you along your journey and helping you become a consistently profitable trader and protecting your capital in these really volatile and tumultuous times. So we'll see you in the trading room.